Today is a terrible day for crypto. Everything is down and this entire week has been bad for all risk on assets. The stock markets sold off a lot on Thursday and on Friday as well. They're probably going to sell off today one more time, and that's all because of the Trump tariffs, right? People are now expecting that global trade will slow down, and with that company profits go down as well. Everything risk on is down. Now, I hope, because you're watching this channel, that you're impacted by the negativity a bit less. I hope that you have bought the dip a bit less frequently, or maybe with smaller amounts. I hope that you've also seen the warning signs. The Bitcoin strategy members are definitely profiting from this current movement. Here are the recent trades that have been shared by the members. Pretty much everyone is currently up by large amounts, and again, that's because we are betting on falling prices. Here is the now infamous picture. This is a table of what kind of tariffs the USA is going to impose on various countries. Here is the S&P 500. We have seen massive sell-offs. We are now at levels we haven't seen for an entire year. The Nasdaq 100 sold off as well to a similar degree. And it is actually not a surprise that crypto is selling off a bit later during a crisis like this. First, the stock sold off on Thursday and on Friday, and now on Sunday and Monday we see crypto selling off. Now, why do we have that delay? It's because fund managers sometimes take their time to execute trades. It's the exact same that we saw during the COVID crash. So what we have at the bottom is the S&P 500 during COVID. So this is where the stock market went down by 34%. We are not yet there with our current correction, but have a look at Bitcoin. Bitcoin really only had the major sell-off on the 12th and 13th of March. And by that time, stocks already sold off by 19%. So there was a delay. When there's a liquidity crunch, it does take some time for this to spill over to various asset classes. It looks like this time we've got the same. The S&P 500 went down massively, and it did take several days for Bitcoin to react as well. Now, some people are surprised that the gold price also went down on Thursday and on Friday. That's kind of counterintuitive, right? When everybody is very spooked, when everybody thinks risk on asset should sell off, why does the risk off asset sell off as well? Why aren't people buying gold when they're selling stocks? Again, it's because people expect credit to dry up. Gold declined by 3.2%, but it's likely going to recover much faster. Let's have a look at COVID again. At the top, we've got Bitcoin. At the bottom, we've got gold. So when Bitcoin sold off by more than 50% during those 2 days. So when it went from $8,000 to below $4,000 in a matter again of 2 days, gold, which we see at the bottom, also went down, but then it recovered very quickly to the price levels before that crunch. So during regular times, gold and risk on assets are negatively correlated. One thing goes up, the other goes down, and vice versa. But when the external shock is large enough, when credit is contracting quickly enough, then everything goes down at the same time, and the only thing that's going up is cash. And for that reason, you do want to have a bit of cash allocation as well, just to buy bottoms like this. Now, of course, gold relative to the S&P 500 still outperformed. Most selling happens on the volatile assets. But here's the thing most people don't understand. Most people have too much of a focus on what individual assets to buy. So what stock should I own? What altcoin should I own? Those are normally the things people think about, but it's actually not what matters. Yes, there are some people that can pick the right altcoins, but I think the macro environment is much more important. It's better to figure out, are we currently as per tendency high or rather low? Here is what's most important. This is gold relative to the S&P 500. So this time we are looking at two asset classes. We are not looking at assets within an asset class. And just have a look at the magnitude of that volatility. If you bought gold at the beginning of the 1970s and then you sold it 10 years later, you outperformed stocks by 1,900%. You got 20 times more money just by timing the asset classes. And if you then bought gold over stocks, when stocks outperformed, you lost, relatively speaking, 97%. Being in the right asset class at the right time is much more important. Figuring out where the macro is going is much more important. And so yeah, gold is currently outperforming again. And yes, I don't think it's that expensive relative to stocks. Now, there are always the naysayers, right? There are always the people that say time in the market beats timing the market. And if you simply just dollar cost average into the asset over the long term, we will come out ahead, which kind of is true. You can force success by just buying all the time. You can do this with the stock market. You can just have a savings plan, buy a little bit into, say, the S&P 500 ETF, and you will come out ahead if you do this for 20 or 30 years. Same is true for Bitcoin, right? If you dollar cost average every month into Bitcoin and you do this for 5 to 10 years, chances are you will come out ahead. But is it actually the optimal strategy? I'm not so sure when we look at volatility like this. Can we really ignore that gold outperforms stocks during some periods by 20x and that it sometimes contracts by more than 97%? Can we just always dollar cost average into stocks and not buy gold ever, or just have a small allocation to gold? Should we really ignore those kinds of shifts? I don't think we should. I know this is a contrarian take, but I do believe that timing the markets does make sense. Not necessarily being always in cash and just jumping in and out of the market with cash, but rebalancing portfolios based on what's currently cheap or expensive does make sense when volatility is high enough. So here's the other argument, right? There is a way to just force success by buying into Bitcoin all the time. So for example, here we've got $1,000 that we invest into Bitcoin for 3 years. And yes, when we are in a bear market, we tend to be in the losses, obviously, but then we tend to also recover because Bitcoin has better tokenomics than fiat currency. Fiat currency expands faster. And yes, if you just did this for the last 3 years, you still have more than 100% return. So you invested $37,000 and you're now at $84,000. What you invested is here in gray, and what you then get out of it is here in orange. And the same, of course, works also with stocks. The same works with any asset class that has some kind of value over fiat over the long term. But besides not being an optimal strategy, right? Besides not using the volatility that happens across asset classes, I think especially the stock market investors have it wrong. Because here's the argument. This is the S&P 500. The argument goes like this. Yes, sometimes there are bear markets, but if you just hold for long enough, and that can be 10 years, you're still getting bailed out, right? Long term, the stock market is going up. And usually, if you're holding for at least 10 years, you should be fine. This year is 13 years, but still, right? If you dollar cost average in, especially, you're definitely ahead because you take advantage of those lower prices sometimes as well. The issue with that is that over time, money is less valuable. As in, if you've got $100 today, that's going to be worth much more than $100 in 10 years. That's in the end the main reason even why we don't hold our cash just in plain cash, right? That's why we have to invest, because the monetary base is expanding, and it's expanding faster than most people believe. This here is USM2, so the money supply in America. The chart starts in 1959 and it tends to go up over time. This is the linear scale, and here's the same on a logarithmic scale. How quickly is this going up? The answer is quite consistently by roughly 5.9% per annum. So this is actually how much money devalues, by 5.9%. Now, some things don't get expensive that quickly, right? A lot of consumer goods get easier to produce over time, and that technological progress also reflects in the prices, of course. But other things can't expand that quickly, right? Land, for example. Land does appreciate by 5.9% per annum. Again, because the money depreciates by that rate. And so when we look at the S&P 500 relative to the devaluation of money, so now the S&P 500 divided by USM2, now we get a very different story. Now to really get bailed out in same purchasing power, so let's say we want to buy land, it doesn't just take 5 years or 10 years, it can take more than an entire generation. This is from 1962 to 1997. 1997. So that's 35 years. Nobody wants to wait for 35 years just to get their money back at the same point where they started. Now, this is not necessarily a 100% fair comparison because the S&P 500 also has a dividend yield. But at the same time, we also have potentially costs, right? Management costs. Let's say you've got an actively managed fund that might also cost 1 or 2% per year. And then on top of that, you also have potentially taxes to pay. If you don't have to pay any taxes and you save in something like VOO, so a very cheap index ETF, yes, you might do slightly better than what's represented over here. But if you do have to pay sometimes taxes because you speculate, or you do have to sometimes pay more fees because you buy not the cheapest of the funds, then this is here representative, because the fees and the taxes will balance out with what you get in dividends. Now, I know that this is not necessarily the story that most people want to hear. Most people want to just get easy solutions, right? Just putting the money into one thing and letting it ride over the long term. That's the easy solution. But it's very far away from optimal, and it can lead towards situations where you have to wait for more than 30 years to get your purchasing power back. I'd actually not be surprised if we are now in such a situation, because historically stocks are expensive. If you look at the historical Shiller PE ratio, or if you look at the market cap of the stock market relative to the US GDP, or if you look at the S&P 500 relative to money supply, no matter what kind of chart we look at, it seems like stocks still after this correction tend to be long-term over the decades expensive. It does take a bit more of an active approach, but in order to get ahead, we have to do things that most people don't do. We have to buy the asset class that is not sexy at the time, and we have to sell the thing that everybody wants to hold. Currently, still people want to hold their AI stocks, their Nvidia. They still want to hold their Tesla. They still want to hold their Bitcoin. Very few people still advocate for gold. And when it comes to crypto, the vast majority of people still bet on rising prices. There's a good chance that you are losing money today. While again, it is so easy to make money right now, the vast majority of altcoins tends to underperform Bitcoin most of the time. The reason why most people don't do it is because it looks complicated, right? It looks risky. People say that when you short the market, when you bet on falling prices, that you can lose everything. And that is true, right? But the same is true if you buy GameStop at the hype and then the thing crashes. It's about being positioned strategically in the right direction and then make short-term bets on that direction. So for the bull market, everybody knows about this, right? When we are currently going up, then it's about finding the right altcoin that might do the next 5 or 10x. That's the easy part. That's the thing where most people make money. But then everybody loses it afterwards. Very few people are prepared to do the exact opposite, to short the market when we see a price pump. When directionally we tend to go down when people are spooked, and then look for assets that currently are overvalued and then bet on falling prices of those assets. That's currently how I'm making money. That's currently how the community makes money. And so if you want to join us, right, if you want to figure out what kind of altcoins are likely going to continue to go down, if you want to make those nice returns that the other community members do as well, then feel free to check it out. It's thebitcoinstrader.com down below. Now, because most people already lost money in this market, because most people have a somewhat tighter wallet, I've already reduced the rate from 165 to 125. I actually think it's easier to make money right now. The vast majority of altcoins underperforms Bitcoin most of the time. In the top 100, so in the top 100 largest cryptocurrencies, it's roughly 80% that did worse than Bitcoin in the last year. And so it's all about having the odds in our favor. It's not necessarily about 10xing the capital within a few months. It's more about doing 30% here, 50% there, maybe 60 or 70% sometimes. Do that with somewhat small amounts in the portfolio and then grow the portfolio over time. It's just as simple as that. It's not that complicated. So yeah, if it's the very first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. Helps the channel grow. See you next time on YouTube, or see you in Premium. Cheers.